Good afternoon, everyone. I am Carla Boyce, head of our premium VIP banking here at Scotiabank Barbados. Welcome to today's event titled An Economic Overview, International and Caribbean Perspectives, jointly hosted by Scotiabank Premium Banking Jamaica and Barbados for our very own client relationship in both these countries. It is an absolute pleasure to join you for today's discussion. Before we get to the presentations, I'd like to briefly touch on the house rules. We only have two. You're encouraged to type any questions that you may have on today's topic into the meeting chat. Once the presentation is complete, we'll move into the discussion. Now, allow me to introduce you to our panelists. Joining us from Scotia Wealth's International Investment Advisory Group is in Toronto, we have Scott Stallmeyer, our Senior Private Portfolio Manager and Cross-Border Wealth Specialist, here to provide international context and our house view from Toronto. Scott specializes in servicing Scotia's clients throughout the English Caribbean, including right here in Jamaica and Barbados. His insight is particularly suitable for us as he grew up in Trinidad, sweet TNT, and has been servicing our region for the last 15 years. His experience is in building and successfully managing business relationships with highly accomplished entrepreneurs, business owners, and senior executives such as yourselves. Scott has been living in Canada for over 20 years and uses local and international insights to mold sound and relatable strategy. He provides his clients with the resources needed to enhance and protect their wealth, as well as optimize and preserve their legacy. Scott holds a professional MBA from McGill University, as well as the Chartered Investment Manager, the CIM designation from the Canadian Securities Institute. We also have Kevin Walters, Acting Director, Market Risk for the English Caribbean region, who joins us from Scotiabank Jamaica to provide our regional context and commentary. In his current capacity, Kevin is charged with leading the Caribbean Market Risk Management team, with a regional team that not only focuses on monitoring, measuring, modeling, and reporting of market risks, but also partnering with key Scotiabank stakeholders across both profit and risk optimization initiatives. He's a seasoned finance professional with 13 years experience, 10 of which with the Scotia Group, in areas such as risk management, financial and economic modeling, investment strategy and analysis, asset allocation, strategic influencing, and security pricing and valuations. Since joining the Scotiabank team in January 2012, Kevin has been progressive roles in various areas of the group, such as underwriting, portfolio advisory, and market risk management. He's a chartered financial analyst, CFA, and holds a BSc in economics special honors. And now I'd like to ask Scott to kick things off.
Thank you, Carla. I appreciate that very kind introduction, and a warm thank you to everyone who set aside the time to join us today. As Carla implied, I grew up in Trinidad, but living in Canada now about 25 years, 16 of those years of which have been in cross-border wealth, mainly servicing families throughout the Caribbean, English Caribbean rather. And so it really is a pleasure for me to be here. I have a lot of family, friends, colleagues, and clients in both Jamaica and Barbados, many of which those relationships are going on over a decade. So to be here and share Scotia's view for a Caribbean audience is really a pleasure to be a part of. And we hope that you get a lot of useful ideas out of this, or at least clarity in terms of where things are going. So as you gathered, we really have two goals today through this presentation. The first is to provide Scotia Capital's head office views on what's happening currently in global markets, as well as where we see things going from here. The second goal is to pair these international themes along what's happening specifically in Jamaica and Barbados, as well as the broader region, to which, of course, my colleague Kevin is going to lead that part of today. Both of us will really aim to pinpoint the key themes, keep things as simple as we can, and focus on the most important ideas that are useful really for you all from the lens of being investors or from the lens of being just business people. So in listening today, you'll find that while there's certainly headwinds and uncertainties, all of you have the news, our research is supporting net growth still, albeit notably less than previous years, and certainly less than was expected at the beginning even of this year, just a few months ago. So the undertone that is important is in times where uncertainty is elevated as of now, opportunity certainly tends to present itself. That said, you have to approach that with discipline and patience, and quality advice is really an important undertone. So all said, let's jump in. We'll start with just a quick recap of the last 2.5 years, which really sets the stage for where we are now and where we're going. A lot of you will know the gist, so I don't need to spend a lot of time. 2020, COVID-19 creates the fastest and deepest recession on record. So, you know, it still has a lot of us in shock, despite it being 2.5 years now. But ultimately, quarter over quarter, much of the world experienced a GDP drawdown of almost 25%, or depending, you know, give or take. So what's fascinating is despite that major drawdown, as fast as it happened, growth also returned almost as fast. And through the end of the year, GDP was only down, global GDP was only down about 3%, respecting that every country had their own experience of that. This is the aggregate. The damage obviously was quite severe, but pretty well undone quite quickly. And record stimulus really had a huge role to play. In particular, recall most central banks set interest rates at this emergency near zero target, right? Which of course is now being unwound, which we'll talk about later. The global economy roared back, fully recovered what was drawn down, and then also achieved impressive growth. On top of that, through 21, I think GDP was 6.5% to a long-term average of about 3%. Next, inflation starts to kick in, which prompts central banks to react, albeit perhaps a little bit too late. But the central banks around the world started to unwind those emergency zero rates that I mentioned a minute ago, which at the time was welcomed and sensible. Things really started to change in February and March. Now, the Russia-Ukraine conflict, both countries, major participants in energy and agricultural commodities, which compounded this building inflation issue and ultimately led to the intense inflation experience of the last few months. Central banks basically had no choice, was part of their mandate to control inflation, and accordingly they responded with more raises more rapidly, which we're all experiencing, and it's all over the news, of course. So again, the rising rates is not necessarily a problem on its own, and in fact originally started off as something that's just normalizing. In you know, let's say 2018, if interest rates on average are around 3, and 2020 they put them to 0, well they were coming back to 3, or at least you'll see that later on in presentation. But again, on its own, it wasn't a particularly bad issue. It's just now the pace of raises is just happening so rapidly that it's creating a lot of uncertainty and of course downward revisions in global GDP and corporate earnings into 2022, or the rest of 2022, and of course 2023. All of this is really why we've experienced so much volatility this year. And we'll expand on the coming slides with benchmarks to understand what these numbers really mean relative to long-term norms. So on the next slide, we see the market reaction. So far for 2022, if you're an investor, you likely know this already. Apart from commodities, which oil, for example, is up about 40%. Maybe defense contractors, energy, materials sectors are up quite a bit as well. But pretty much most global markets experience a drawdown of greater than 20% from their highs. This is what constitutes what's called a bear market. What does this mean? Basically, there was nowhere to hide this year so far. The average balance, which is industry speak, a balanced portfolio is industry speak for a medium risk portfolio. It's down about 15%. What's uncommon this time is that it's both stocks and bonds that are down, quite meaningfully so. So, for example, the average bond fund, and you can see on the charts, just aggregate of these categories. But the average bond fund is also down about 15% this year, which is equity-like volatility. And that kind of move hasn't been experienced in the broader bond markets since the 1980s. So keep in mind as well, bonds are generally categorized as capital preservation and income-producing assets. So it's not common. And even, we could look at government bonds, for example, or US government bonds. Even that which is considered risk-free in their ability to pay, even those are down 10%. And to understand what's going on, last year, if the average treasury was paying 0.5, this year the average treasury is paying 3.5. So if you bought a treasury last year and you show up to market, everyone's getting 3.5 in the treasuries, and you show up at a 0.5, what happens? No one wants it. It of course gets pushed down. Bonds will mature at 100. You probably get back your principal depending on the situation, but in the near term, there's a push down on value. All said, difficult first half of the year for investors. Not to get stuck only on rearview mirror, because really what's more important is forward looking. These moves are dramatic, and they can change, or they have changed, the outlooks for what's to come. On the next slide, we'll unpack inflation a little bit. So again, on the same theme, some inflation was expected and fairly normal. When you go from no activity to a lot of activity, the change represents a big percentage. So inflation itself was not a surprise. The amount of inflation was a surprise, and that is due to, well, the Russia-Ukraine created the surprise that has us in the situation that we're in. So ultimately, they lengthened and compounded this problem. And it's interesting, Russia is only 3% of the world's economy. So on its own, it's not neither here nor there, but combined, Russia and the Ukraine are just such large participants in global energy and commodities, agricultural commodities, namely natural gas and wheat and cooking oils, that it's in this time of inflation, they have created this compound on it. So as you can see, with the exception of China and perhaps Japan, not listed here, inflation is pretty much high across the board. The US takes center stage typically, and the most recent reading was 8.5, which is down slightly from last month. Before that, 9.1, but both of these levels really have not been seen in decades. One thing I'll say, and keep in mind, inflation is a year-over-year change calculation. So in a simplified example, let's say the barrel of oil goes from $50 to 100 last year. It's not expected to go to 200 this year and 400 the year after that. Meaning that percentage change, that impact it just naturally mathematically is going to curve down. And this sort of 9% inflation is just not likely to exist into perpetuity. So you see the highlighted slides and the cells in yellow showing that this expectation, and that's a consensus, it's not only Scotiabank, is expecting inflation to tick down into the threes in 2023. Interest rates are tied to inflation, and same thing, if you look at the blue highlighted slides, you're getting the same message. As inflation comes under control, or at least ticks down, the rising rates are also expected to level out in the mid threes. And in fact, on the right-hand side, you see expectations, in fact, forecast a rate cut in 2023. Basically, if to simplify, this is a real problem. It absolutely is, but the expectation is that it's slowly going to come back on side, and we should see some more constructive changes coming into 2023, at least on the inflation and on the interest rate side. On the next slide, we'll dig into unemployment a little bit, which in part is good news. So global unemployment, again, respecting that every country is different, but as an aggregate, is really quite low. US unemployment is actually about 3.5% right now, which is the lowest reading they've had in 50 years. Canada's about 4.9, also well below, as you can see on the right-hand side, well below the pre-COVID levels, and continuing a downward trend. Japan 2.5. On the one hand, that's good for consumption, good for economy. Everybody's employed, and therefore money's moving around. But on the other hand, we're in a position of inflationary problems, and so if the labor market is so tight, that now adds wage pressure. So it's good and bad. But right now, over 60% of companies surveyed expect a wage increase on averaging around 6% for the coming 12 months. On the next slide, adds a bit more support that inflation should trend down in the coming months. This is important, and really where our eyes are on the most, I would say, at least within the context of inflation. Things are still elevated. Commodities are certainly higher than they were, over the last 24 months. But most commodities are really notably off of their highs. Industrial metals, as you can see on the left, many of them are down by 30, even nickel on the high end of over 50% from their highs. Similarly, global freight rates are down roughly 35% from the 2021 peaks. And I hope for a Caribbean audience, obviously countries that tend to be big importers, I really hope that scenario is being seen in the region. There are also supply guts. For example, Walmart, Target have all formally announced discounting plans to deal with what was described as problematic inventory levels. Supply chains are supposed to ease in China. That's the guidance. The zero COVID policy is supposed to be a bit more deliberate, as opposed to widespread. All of this against global demand slowing gives evidence that the inflation situation might turn a little less difficult through the coming months. The next slide also supports this a bit more. I trust everyone, in particular on the Jamaican side, I saw the Jamaican dollar actually ticked up in recent weeks, which I'm sure Kevin will get into. But nonetheless, I'm sure everyone's noticed the US dollar is notably up through this period. It is a common response during times of uncertainty, as the USD is effectively the world's safe haven. It's a store of value, but also because they ended up raising their interest rates first and generally higher than any other, global alternative. So currency investors are basically getting paid to wait, so to speak. There is some good in this. So most importantly, for the US, a stronger USD actually dampens the effects of inflation at home, as their dollar is buying more of those goods that have components from international markets and so on. On the other hand, a stronger USD can weigh in on multinational US companies who earn foreign dollar, because of course they report earnings in USD. So it's a little bit give and take, but as solving inflation or solving the inflation problem is really what's most important. Higher USD is actually net positive here. So I move on to the economy on the next slide. So on the right-hand side, you see expected economic outcomes, while on the left simply highlights the downward revisions that have been made through this period as things have evolved. So as mentioned, we expect lower growth through the coming 2 years. And to put this into context, if you single out the world, the one in the middle of the world, the 30-year average GDP growth for the world is about 2.9. So for us to forecast 2.9 GDP in 2023, it's not awful. It's just significantly lower than it was in the previous few years, and it's significantly lower than we had expected just 6 months ago. So there's an adjustment that's taking place. Moreover, the key question is typically whether the economy is headed into recession or not. And after a 1.6 contraction in the first quarter of this year in the States, and a 0.9 contraction last quarter, a simplified definition would imply the US economy is in recession right now. The bureau that defines what a recession is in the United States includes unemployment, which of course is notably low, and they also include the depth of the drawdown, which 0.9 is neither here nor there. So in that context, it's up to academics to decide. But ultimately, our models looking forward indicate that the risk of recession through 2023 is increasing. It's not the prime scenario that we think will play out, but if it does, our belief is that it will be short-lived and relatively shallow on the changes that we've been mentioning through these slides. It's hard to say how all this will play out, and while events like this have historically been opportunities for long-term investors, ultimately you want to be disciplined, diversified, and goals-aligned portfolios are the ones that have paid off through countless crises, and are the ones that should continue to do so. On the next slide, we'll just look at major asset classes, starting with fixed income. Okay, so as mentioned, fixed income markets have gone through a major sell-off in response to higher rates. We believe much of the damage here is likely done, and forward prospects are much more constructive from here going forward. So, for example, looking from last year to now, the average US agency bond last year was paying about 2.5%. Now you're paying about 3.5%. Similarly, average investment grade corporate bond last year paying about 2.75. This year, 4.5. High yields, which you need to be a bit more selective on. Last year, we're averaging in the 4s, now averaging in 6s. So we are seeing rates and yields for fixed income investors that we haven't experienced in almost a decade. Not all bonds are equal, and you need to focus on quality in our opinion. Governments and investment grade governments and investment grade bonds are favored, whereas high yields, you need to be a bit more selective, as they depend more on renewing maturing debt, which will have to be replaced at higher rates, and it's a bit more difficult for them to process. One sensible strategy for people who are thinking on what to do through something like this is very simple, simply laddering your maturities. So for example, you got $500, I'm simplifying, $500, you've got one to mature in 1 year, one in 2 year, one in 3 year, one in 4 year, one in 5, and you have 20% of your money that is maturing like a ladder. You're able to dampen the effects of interest rates going up, interest rates going down, and certainly cut volatility through that. On the next slide, we're going to dive into equity markets. On the left is some good news, something I've been looking for a while, a couple of years now. Equity valuations have normalized and are now actually slightly below long-term averages. That is warranted somewhat given the lower growth forecasts, but certainly one area of previous concern has been fixed somewhat. On the right-hand side, looks at earnings outlooks, which over the long run, as investors, we know prices will follow earnings. And so high single-digit growth, as implied, at least in the States. Again, while it's less than recent years, it's not minus, it's not negative, it's just less than previous. One also for equity investors, one sensible strategy through volatile markets, or what we do on our side, is what we call dollar cost averaging. And so if you have $100, you're breaking that up into X amount of tranches, whether that be 5 pieces, and you're just slowly deploying over the months to quarters. So you're not buying all on one day and risk timing along the way. You dampen the effects of that. On the next slide, we dig into how equities have behaved through every recession over the last 70 years. And this is where people who are thinking to themselves of trying to time in and out of the market, this is the kind of content that in my view, makes that strategy just very, very difficult to win at consistently, if at all. Basically, you know, again, the starting point is that we don't think a recession is absolutely certain in the coming 12 months, but probabilities are leaning more and more to that direction. All recessions also are not created equal. You know, and again, for reasons mentioned, we believe if a recession does play out, it will not be particularly deep, and it will likely be short-lived. So all said, historically, the average recessionary drawdown through over the last 70 years has been about 27%. Noting at its worst point in June, the S&P 500 was down about 24 from its high. So more or less very close to this benchmark. Another thing to realize is that sell-off typically starts about 7 months before the recession starts. And on the same time, the recovery starts about 6 months before the recession ends. So again, trying to time things in and out becomes very complicated. And volatility, when it's elevated, you might have a day where the range, you might have an 8% range on one day. It's just impossible to time. Paul said, the forward 12 months average over the last 70 years, or judging from on average from the last recessions over the last 70 years, is nearing about 40%. So that's something, again, in terms of timing or just sticking to the course, it's something to sink into. On to the next slide. So all said, the world is slowing. Quite a lot of damage has been experienced. Volatility in the near term is likely to persist. And that's until clarity on inflation and therefore interest rate policy starts settling in, and we know with confidence that those forecasts are being realized. This is a time to focus on quality, focus on discipline, diversification, and advice. The world will certainly get through this, as it has many times before. And a well-structured portfolio of quality holdings, are the ones that typically weather the storm the best, typically the ones that recover the quickest and get on to growth, or get back onto growth the fastest as well. So that wraps up the international component for today. With that said, I want to pass things on to my colleague Kevin Walters in Jamaica, who will share more regionally focused context for your benefit. Thank you.
And the overall seismic shift that we saw at onset of COVID. Now, we expect tourism to remain at the center stage going forward. Zooming in when we look at the slide, when we look at the levels that we're seeing, they are very encouraging, even though there's a fair amount of slack that's still there, because when we look at pre-pandemic levels, we realize that we're not quite there as yet, but the trend is actually positive. Now, one of the things I want to stay close to, and Scott would have mentioned it in his presentation, there is some amount of fears about recession taking place, particularly in the UK and the US, and those two areas are very important for Barbados. Is visitor arrivals, UK accounting for approximately 29%, while the US accounts for approximately 42%. So while we still see some opportunity, there are some concerning headwinds that we have to stick close to. But I guess the positive on this slide is that when we look at where the visitor arrival or the tourism industry capacity is still below where it was pre-pandemic. So, there's some amount of growth that, we could expect to see going forward. Now, when we look at the GDP, and, our expectations are driven largely by what we see, taking shape on the previous slide, because Barbados, the central bank reported growth for half year so far of 10.5% for the first half of the year, and that's the 5th consecutive quarter of growth. And we have to take these numbers into context. As we can see from the charts, over the last couple of years, Barbados has been experiencing some challenging economic performances. And in keeping with the current fiscal recovery, or the fiscal trend that we're seeing, where there's the restructuring program going on by way of the IMF. From this standpoint, the results that we're seeing are definitely positive in terms of things heading in the right direction. However, we have to look at what was happening over the last couple of years. And over the last couple of years, the economy has been in a slump. So the positive numbers, we have to take it into context that there are low base effects, and we are not quite where we would want to see the economy. However, again, drawing back on what I said on the previous slide, there's still significant amount of slack that's in the economy, and we feel that if things continue on the current path, we could see some more positive performances going forward, and that augurs well for the country. And in keeping with what Scott would have presented earlier also, in terms of the Barbados' labor market, We're also seeing where tourism again is at the center of that recovery, and it's expected to continue delivering a lot of labor gains that we've been seeing over the last couple of years. But what is also important, when we step away from the gains that we're seeing in the tourism industry, we're also seeing gains in different areas of the economy, such as wholesale, retail, transportation, communication. And it strikes at the heart of the discussion that we're trying to have here today that, there are several linkages that we're seeing in the economy. And as tourism improves, as the global economy, continues on a steady path, and we see those flows going into Barbados, then the linkages and the overall economy will stand to benefit. So this is something that we'll maintain some tension on in terms of observation to see if this continues going forward. And on the next slide, not necessarily an elephant in the room at this point. Inflation is front and center, and Barbados is no exception. And the nature of this economy is that it is very susceptible to external price shocks, and we're already seeing that. And having this high level of pass-through, whenever energy prices move in the global market, we tend to see that impact price levels at the local level. And, just drawing back on some of the things that Scott would have indicated in his presentation, the silver lining here is that we're starting to see some amount of tapering, and the expectation is that over the coming quarters, we'll start to see some moderation in energy prices. We'll start to see where, probably commodity prices start to come off a bit. And, that overall will definitely be a positive for the economy. But as it is right now, we're still feeling a lot of the price pressures. And the concern is that, this will still have to be faced over the upcoming quarters. No, and this slide is one of the more positive stories coming out of Barbados, and that's the debt sustainability statistics. Now, debt to GDP over the last year would have improved by 10 percentage points, from 136 last year to 126 this year. And the primary reason for the reduction, is largely being driven by, as we previously discussed, the improvements in GDP. And going forward, we're likely to see where, a lot of the fiscal austerity and fiscal discipline will start to improve this number. And this will be very important for Barbados as they start to emerge out of the IMF program. To sustain an economy, there's some amount of borrowing that will need to take place. And what we'll see is that some amount of that borrowing may not be able to be supplied by the local market, and the government may have to tap the international market again. And it's going to be very tricky based on the fact that the market has a very long memory, and taking the default in the context, the costs that might face the government at that point might be a little bit on the higher side. So the importance here is that the government has to get GDP back on track so that the debt statistics will, encourage international investors that, Barbados is the type of economy that you can invest in. So that is something that will be very key to see how that improves over the upcoming quarters. And on the right side of the slide, we looked at gross reserve, which remains robust despite this declining on the back of much of what was discussed earlier, higher global prices, particularly energy and food prices. And we see where a lot of the key themes of inflation are actually filtering into the overall reserve level of the Barbadian economy. Notably, though, the coverage is still robust, approximately 34 weeks, which is well above the international guidelines. So from that perspective, the reserve levels are still strong, expected to be bolstered by improvements in tourism. Now, the IMF may be leaving soon, so tourism and other key FX earners will start to support the reserve levels. And just to recap, and in keeping with most of the themes that Scott would have spoken about, we're in the midst of a lot of uncertainty, and there are potential headwinds that we expect to continue. There are, these are somewhat counterweighted by some gains that we expect. So, on the downside, we continue to see where, import dependent economy will have high pass-through that will be tempered somewhat by some amount of recovery that we expect to see in terms of prices. Global growth slowdown, particularly in the UK and the US, will definitely be something that you have to keep an eye on in terms of tourism. But on the positive side, the international reserves, they remain resilient, and the recovery in tourism is expected to support that. And despite the headwinds that we expect to see in tourism, as mentioned earlier, because of the tremendous amount of slack that is still in the industry, we still believe that it could remain resilient. And I want to segue a little bit into Jamaica, that we are seeing a lot of the themes are similar to what we've seen in Barbados. The Jamaican tourism industry also remains below the pre-pandemic levels, but we're continuing to see signs that a sustained recovery may be on the way. The overall performance of the industry is projected to continue along this line, and again, we're seeing where even though there are fears of recession kind of emerging in the market, some of that pent-up demand that we would have seen previously are what's keeping the industry afloat. Now, one of the things about Jamaica is that the visitor arrivals is a little bit more concentrated compared to Barbados, with 75% of our arrivals coming from the US. So it would be very key for Jamaica that the US economy continues to be robust, and even though there are concerns about inflation, just the overall labor market strength, etc., could sustain visitor arrivals going forward. But we do maintain a certain degree of caution with respect to just the overall slowdown in the economy. From a GDP perspective, we're still seeing where the economy is growing, and a lot of that has to do with the relaxation of COVID-19 measures, and also, as mentioned before, tourism. And what we're seeing is to an extent, there's a shift in the consumer dynamic. Now, when COVID was at its peak and there was a lot of lockdowns, what we saw was that the goods producing sector was the main catalyst for the fledgling recovery that we were seeing. However, once we started to see the economy open up a little bit more, we started to see where the services sector started to really drive growth. And a lot of that is coming from hotel and restaurants and the service industries. Now, the improvement in tourism, again, is something that's very key to the overall economy. And what we're seeing is that, that would have contributed to the improvement in the unemployment numbers, which are at 6% currently, which is somewhat of a record low. And we're also seeing different subsets of the economy show strong labor gains. And that's a positive, that the recovery is actually more systemic than concentrated in a particular area. Moving on to the next slide, we look at the chief FX earners, and Scott would have touched on this a little bit earlier. So for much of 2020 and 2021, the growth in remittances were buoyed by some of the unprecedented stimulus efforts that we saw in the US. The leading contributor to our total remittance in Jamaica, and supported by the previously mentioned strong recovery that we saw in the labor market. So though when we're looking at the growth here, though it's positive, as you can see, the growth has slowed significantly, and this is within what we expected. We expected that when the borders were open, we would start to see where more informal remittances channels were going to be used. Also, with the reversal of some of the fiscal support, we expected to see some reduction there. And what we're seeing is that we're seeing some amount of that effects kind of filter into the net international reserves. And while we're still seeing a robust stock, the runoff from the peak in December, we're not really concerned at this point based on the sufficient cover that we have. And a lot of what we're seeing happening with the reserves also is the central bank's current initiative to maintain stability in the FX market. And Scott would have mentioned it before, where he's seeing where the Jamaican dollar has appreciated against the US dollar. And that's a deliberate strategy by the central bank that we'll touch on in the next slide. So when we think about exchange rate stability, it is a key goal in the Bank of Jamaica's fight against inflation. So essentially what the Bank of Jamaica is trying to do is maintain some amount of stability, not have the currency run away, because there are significant pass-through effect or second round effects of having the currency appreciating to too high with regards to inflation. Now, how they have done that, whenever they have felt like the demand and supply dynamics were being offset by having too much demand, they would step in and intervene. And we've been seeing a lot of that from the start of the year to current. And we actually expect that to continue, based on, just the deliberate strategy of the central bank and just the communication in terms of their commitment to bringing prices back closer to the upper limit or within range, and they continue to target exchange rate stability as one of the key initiatives to execute on that. And when we look at the left here, we're seeing some positive numbers in terms of appreciation. So the Jamaican dollar up to this point has performed quite admirably against its US counterpart. And it's typically the other way around. So we typically, even though we have the two-way movement, we generally see where the US dollar appreciates against the Jamaican dollar. And importantly, we'll touch on this slide, and the slide itself tells a very important story. If we look at the inflation line there, that was seemingly on a relentless upward march. When we look, we're seeing some indications that there might be some tempering, but when we look at it, it still remains well above the upper limit, and this may be reflective of two things in terms of the tempering that we're seeing. Akin to what Scott would have highlighted earlier, where we're seeing some tempering in price pressures and the slight easing in global prices. We know that, if you take a look back and you look at the chart there, you look at July 2021, at that point you started to see the upward thrust of inflation. And what we're probably seeing here is also the impact of high base effects. So prices were higher July last year. When we look at the year-over-year change, we're starting to see some tempering. So there's still some amount of concern. Having inflation at 10.2 is not necessarily ideal, and not just from the fact that prices are higher and there are several things that people have to deal with, but also with the psyche in terms of you don't want inflation to be anchored, and that's one of the key things that the Bank of Jamaica is trying to combat against. And the next thing we want to look at here is the solid black line, which is reflective of the bank's policy rate. And we see a deliberate effort by the bank to try to rein in inflation. The policy rate, it now stands at 6%, and it has increased from 50 basis points in September last year to 6 currently. So that's 550 basis points movement in just under a year, which is significant. And what we're also noticing is a general change in the tone of the central bank. Now, they don't want to give away too much, but in terms of what they're indicating is that policy rate at about 6 or 6.5 is, generally where they feel comfortable, but they want to leave a certain bit of room to actually hike further. And I think a lot of the hikes that we'll see going forward will be based on what the US Fed does. And the expectation, it was displayed on Scott's slide, that there's probably an additional 100 basis points increase that's expected from the US Fed. And what that will mean is that we may see the BOJ increase also to try to maintain that interest rate differential and try to limit the potential impact of capital flight. So that's something that we should really stay close to. And as it pertains to potential investors in the market, as we see on the next slide here, there's a significant amount of opportunity in short-term securities. If we look at the 90-day T-bill, the 180-day T-bill, and the 270-day T-bill, though from a real return perspective, it's still lower because inflation is 10.2%. But compared to what you used to get on cash or money market securities, it is significantly higher. And we see a lot of investors are posturing towards, taking advantage of that while the cycle lasts. And, that's something that investors can definitely look forward to. So as we see the central bank continue its increase in terms of its policy rate to maintain that differential based on what we're expecting, we do expect that, money market rates will respond accordingly. And as such, there might be some opportunity on the shorter end of the curve. Also, as we see some repricing on the longer end of the curve, given the fact that, interest rates are mean reverting. So at some point in the future, maybe, near the end of next year, going towards the end of the year, we might start to see inflation start to temper off, and we might start to see where just global central banks become a little bit more accommodative. There might be an opportunity there to pick up long-term instruments that are currently trading cheap and benefit from the repricing in terms of a reduction in rate. And just to close off, similarly, what we've seen in Jamaica, it's really similar what we're seeing in Barbados. The economy remains susceptible to tourism-related shocks. Higher interest rates continue to constrain credit appetite, and that's a concern going forward. Potential risk of capital flight is something that a central bank will definitely try to manage. But on the positive, we see we're rebounding tourism will continue to fuel the post-pandemic. I don't know if it's correct to say post-pandemic because we're still in a pandemic recovery. And the revival, we start to see it extend to different corners of the economy. We still maintain our robust level of net international reserves, and as such, that will allow the central bank to maintain relative stability in the market and also limit some of the second round effects of inflation. And what we've seen from the Jamaican government throughout the entire crisis is continued fiscal discipline, and that will definitely boost not only just debt sustainability, but also improve the country's credit profile and actually attract international investors. And and that wraps up my presentation for now. I will hand over to Dana, who will deal with proceedings from here on.
Great perspective, Kevin and Scott. Those are some very interesting views. We are going to take a few questions from the chat. And the first question is, what investing strategies typically do well in periods of high inflation or high volatility?
Sure, you can start, Scott.
In portfolio management, you always say the only free lunch is true diversification. So within the context of a well-diversified portfolio, starting there, the sensible approaches, one is just generally be in a high quality area. I know that's a very generic word, but within portfolio management or equity selection, quality essentially typically means some sort of market leader or sort of a pillar of the economy style company that the world needs. They tend to have pricing power. They tend to, regardless of what's happening, the world is still going to consume them and use them. This is, again, getting maybe a bit more nuanced, and you probably need somewhat help with this. So of course, lean on your advisors. But generally, you want lower debt companies. Generally, you want companies with larger margins because they can digest those changes. One, again, within the context of a well-diversified portfolio, typically financials are a hedge to inflation, at least over time. And it's quite simple and logical. If banks make a percentage of the underlying percentage, as that percentage grows, as the reference rate grows, of course, banking revenues grow with it. That's one side, or that's this positive side. There is also a headwind with that, in that if interest rates go up, too fast, or the customers are not able to adjust, you then have issues of delinquency. And so you've seen, if you're paying attention, or if you've noticed, financials have actually had a pretty bad year this year. A lot of them are putting loan provisions or loan loss provisions in hypothetical losses on their books, which is adjusting the stock price and so on. But long term, that tends to hedge things out. And then in terms of I'm thinking more that maybe the volatility side of it is more important, because again, within our view, the expectation is, yes, inflation is decades long records at this point, 40-year records and so on. But that is expected to taper off, and it's not a permanent, or expected not to be a permanent problem. And so once you get through that, it's really this period of sort of uncertainty and big change from a ton of growth to really a little growth, or at least certainly less. That said, the volatility through that transition, which maybe we're well into or through, I'm not sure if we're on the other side of it yet, that would probably be more prudent. So I would think back to what I was saying on market timing. One, you don't want to try and go in and out, and I'll use COVID as a serious example. That's an extreme example, but through COVID we experienced the fastest -30 ever recorded, and that was 2 weeks long. And then we also experienced the fastest +20 ever experienced, and that was 3 days long. And there was no real change. The world didn't know what COVID was yet. There was an expectation that all the stimulus was to come. Nothing was finalized, but the market was up 20%. There is no logical way to time that. And so I warn people who think they're going to try time things in and out. It's very hard to do. You can typically get the big swings, but doing with consistency is hard. It's better to focus on this quality long-term approach, understanding that good companies are going to survive no matter what. Yes, they're going to draw down with everyone else, typically less so than everyone else, and typically they respond faster and get back onto growth quicker as well. So that's what I would say. Again, thinking within a diversified portfolios, keep the quality involved. Wait until things are a bit more certain before I typically don't do anything speculative, but if that's your nature and your risk profile.
All right. Another question that was asked is, how do you see the war in Russia and Ukraine playing out and impacting the rest of the world?
Scott, I'll allow you to start on that one, and then I'll take it from the regional perspective.
Okay, fair enough. I think the interesting thing for me through this is that 75% of the world has some sort of sanction on Russia. And this is going on now 6 or 7 months. So the expectation was that they would just financially starve Russia, and therefore the war would have to end quickly. That really hasn't played out. And so I think that's an academic conversation, but policymakers have to sit down and figure this out to say, okay, if this is not the tool that curves this behavior, what is? And so that's going to happen. But ultimately, in the near term, it's very difficult for Europe. That's well documented in the news. The dependency from Europe on Russian natural gas. It's very difficult for food commodities, agricultural commodities that we're all experiencing in our daily lives. But ultimately, the world figures things out. I think on the energy front, conversations around nuclear power are emerging throughout Europe to say, well, we can have our hand in the dragon's mouth, so to speak. But ultimately, the world has gone through all sorts of different complicated situations in the past, and things get out on the other side. It tends to work itself out. I don't see why. Of course, there are probabilities that where this can get more complicated than it already is. But our belief is that it's going to stay relatively contained as a Russian-Ukraine issue, and eventually work itself out.
Yeah, and I'm on side with that response. And in general, the direct linkages to the conflict, we're through some of our major partners such as the UK, the US, and just the overall impact on energy prices, etc., is what started to filter through to the Caribbean. And the Caribbean is very much price takers, and we have to take what's happening in the global economy. So I mean, that was a major concern for us. But I agree with Scott. It seems to, at the initial onset, there was a lot of volatility. It was a lot of concerns. There were a lot of sanctions. There were a lot of different. It was in the headlines a lot. And it was when you looked at the relative search interest in the Russia-Ukraine crisis relative to, for argument's sake, COVID that dominated for the last couple of years, it superseded, but only for a short time. And what we're seeing is that it's working itself out. Yeah, we have higher prices, but even though it contributed to us having higher prices, the prices were elevated before, and at this point, it seems as if it's something that's going to resolve itself. But I agree with Scott again. It's going to be a conversation of how the world figures out, what the appropriate response to this type of action is. But for the most part, it's really going to be through inflation trigger, and if it really dampens European economic activity to the point that it hurts the UK's economy, then we'll start to see that also filter through in impacting our tourism and our overall GDP. So from that perspective, that is how I think it impacts the region.
Okay, we have another question, and our listeners wanted to know, throughout your career, what is the most important wealth management lesson that you think Jamaicans and Barbadian families can benefit from?
Oh boy, that's a good one. So I think Jamaica and Barbados having exposure to the broader English Caribbean, me having exposure to the broader English Caribbean, Jamaica and Barbados are actually a bit more advanced than others in this sense. Being in wealth management for 17 years, you know, seeing families, I don't know, when you're planning for an unborn child who is now going to university, these kind of things, and seeing these transitions over years, seeing elderly generations pass assets down or companies down to generations below, and things that work and things that don't work. I think that the planning side of it is often missed. Well, maybe that's not fair. It's often missed. It maybe is what should be enhanced more. And I use this example all the time. It's a common example in our industry, that 70% of wealth tends to dissipate after generation 2, and 90% of wealth tends to just dissipate after generation 3. And that's regardless, that whole saying, rags to riches back to rags in 3 generations. 1 generation creates, 1 generation maintains, 1 generation blows it. That these kinds of sayings exist in every language, every country, every religion, every race, every industry throughout hundreds of years. And so the example I was leaning into, that we often reference, of one, what not to do, and one, what to do, is the Vanderbilt family is usually referenced as what not to do. In that Cornelius Vanderbilt died 1885, something like that, with the equivalent of today's 200 billion in today's dollars equivalent. And famously, by generation 4, they had a family get together, and there wasn't a millionaire left in the room. And so even $200 billion effectively can get wiped out over 200 years. On the flip side, the family that's often referenced of what to do is the Rothschild family. And so they have been billionaires for 400 years. So we're talking, if 100 years, roughly 3 generations, 12 generations of wealth, and members of that family are still on the Forbes list of billionaires today. And so why is that? And of course, that's planning. It's very deliberate. It's a huge amount of effort and energy to maintain that. As a general rule, coming back to the original question, what would I do? And if I can go back to the beginning of my career now, something that I think that's just an underlying tone, it's very important, is to always, if the biggest problem, no matter who you are, Cornelius Vanderbilt included, is that wealth tends to dissipate after generation 3, well, make sure you think in 3 generations. Make sure that you are planning for you are generation 1, or whatever your situation is, but make sure that you're always planning for 3 generations, and pass that down to the generation below you to make sure they think in 3 generations. And typically, best practices like making sure the 3rd generation is educated, so when that wealth comes to them, they know how to handle it, these kind of things. But that's what I would say as a major lesson that I find has completely changed my way of thinking and the way that we interact with the clients.
I think our next question is of interest to a lot of our viewers. What are your thoughts on Bitcoin, cryptocurrencies, and blockchain technology?
Well, I think they're very interesting. The technology overall, blockchain technology, is something that's very interesting. It is at the forefront of a lot of discussion. But one of the things we have to think about when we think about Bitcoin, one of the initial, and I don't think anybody figured out what it is as yet. One of the discussions before the pandemic was that it was supposed to replace fiat currency. Now, what we saw at onset of the pandemic was extreme drawdowns in Bitcoin, and the level of volatility that you see with cryptocurrency is something that you don't generally see with fiat currency. And also, it it to a certain extent is very volatile. It has no return history in the sense that you can say it performs well in this type of market, it has this type of correlation with this type of asset. So it's still undefined to a certain extent. However, I note that the technology itself in terms of the blockchain is something that's very interesting, and I think something that's going to be at the forefront of the future. The system basically operates on a trustless system. So what it promotes is financial inclusivity. So anyone can access the chain, anyone can transact on the chain, and there's a certain amount of transparency that is there. It also replaces, it's more efficient to an extent, in the extent that you don't need so many you actually don't need um, a lot of the transaction based stuff that takes place in the real financial system. So from that perspective, there might be some efficiencies there. However, there are still a lot of things to work out in terms of how the network can be scaled up for it to handle a significant load of transactions. So, I mean, at this point, I think it's still open to debate what the underlying cryptocurrency will be, but the overall blockchain network or infrastructure, I think, is going to be very important for the future of finance and how we handle transactions going forward.
All right, another question is, what do you see as an attractive investment in the Caribbean?
Well, I mean, there are several attractive investments in the Caribbean. Over the last couple of years, what we've been seeing is that, the real estate industry has been doing well. That has slowed down a bit to an extent where, we're seeing increased material costs, we're seeing higher interest rates, and there's some amount of tempering. However, based on some of the numbers that we're looking at from the perspective of employment, one of the key areas that we saw some employment is, particularly in Jamaica, was the real estate sector. So to an extent, while we see some slowing down, there may be some opportunities there. In terms of financial assets, definitely it would be worthwhile to look at money market securities where, yielding as high as they've yielded in over 10 years. So there's some opportunity here from a portfolio perspective. Also, one of the most important things that wasn't discussed here is the equity market in Jamaica. When we look at the equity market in Jamaica, prior to the pandemic, it was, voted the best stock market in the world twice by Bloomberg. However, the significant drawdown that we saw in 2020, we have not seen a recovery. While we've seen a recovery in several markets and, they are basically operating at historical norms, we haven't seen a recovery in the Jamaican stock market. But what we've seen is a recovery in earnings, and earnings to the extent that a lot of companies are even performing better than they were performing before the pandemic. But there's still some amount of fear in the market. So when we look at, earnings from a valuation perspective, I think there's still some amount of opportunity in the equity market. I think the market is still waiting on a catalyst to move forward. So I think there are several opportunities there. And so both from a money market perspective where, rates are higher, but also from the perspective that there's a lot of good companies that Scott speak about that, are very important to the infrastructure of the Caribbean that, are probably trading at historic lows now, and, might be a good opportunity to over time take some exposure to those companies.
Okay. Do you have any quick rules for general wealth building? That was a question that was posted.
I can take that one. I mean, it does come back to this. I think it starts with a way of seeing things. Yeah, I mean, there's a lot underneath that, but as a way of seeing things, I mean, in our world, you really, all of this is long term in general. You can't buy some. Okay, so I mentioned valuations are very attractive, or certainly on the lower end of the range now with all this adjustment that's happening in global markets. But for the value to be realized, I don't know if that comes back in a month or in a quarter or in a year. So historically, if you're buying equities now, it's going to be it's cheaper than normal, but it takes time for these things to realize themselves out, and there is kind of unknown or uncertainties acts almost like there's dark clouds outside, so you're not going to the beach type thing. That's how the markets behave. so you really have to realize this thing is long-term in nature, and it also comes back to that same idea, depending on what you're doing, but if you are out there to create or manage real wealth for decades and to go through generations and stuff like that, you got to realize, if you have kids at 30 and your kids have kids at 30, that three-generation timeline is 100 years. So, I mean, it's very difficult to conceptualize, okay, I'm going to make this 100-year plan. I mean, we do have clients that ask for that. But that's one of the key things. You really have to realize it's very long-term in nature to make real wealth. And you could look whichever business mogul you attach yourself to or you follow, whether locally in Barbados, Jamaica, or internationally. Rome is not built in a day. It's long-term. It's from repeated, quality decisions made over and over the decades. And I have quite a few examples of clients that are not traditionally, not traditionally educated with fancy degrees from fancy universities and so on, but they have a mindset that over decades has put them into, into a fraction of a 1% of the world. And I think very simply, I'm thinking of a handful of them in particular, they just bring it down to very simple. They're just always buying assets, and you start viewing your wealth as a business effectively, and you start viewing each dollar as an employee, and how hard is that dollar working for you, or how hard is that employee working? Is it working for the government, or is it sitting on the corner doing nothing? But if you make this concept and you always say, okay, I'm just always buying assets, over time, you're typically going to be really, really quite rewarded. And I've seen that certainly through the last 17 years of my career. Even in my own portfolio, I'm up, I don't know, 600% on Apple, having it for so long. But when I first started buying it, I sat down minus 30 for 2 years. I mean, that's one particular piece. But of course, as a huge global, one of the biggest creators of global wealth on earth, Apple being the biggest company on earth, market value wise, I'm giving that example. Again, I'm not telling you to just go and buy Apple. You have to buy things within a portfolio, but just as a good example. So think really long term. Think of your net worth as a business, and don't have cash sitting around doing nothing.
Right.
Right.
And I want to kind of just support Scott's point there, because it's very important. So, when we look from an empirical perspective, what drives portfolio performance is really a strategic allocation. And it's a strategic allocation, which is your long-term allocation. It explains over 90% of portfolio returns. And what that means is that you have to define your strategy, know what your goals are, know what your risk tolerance is, and know what your investment horizon is. And once you stick to that, you are able to, I guess, not only benefit from the long-term gains, as Scott just pointed out, when he bought Apple to his gains on it now, but you're also able to take advantage of opportunities that appear whenever there's a crisis. And whenever there's a crisis, there's always opportunities. So focus on the long term, maintain your long-term strategic allocation, and that will help you to take advantage of different opportunities as they come up. But it is also a roadmap to a certain extent that will help you to to maintain discipline through different market cycles.
All right, and this is our final question. When are we likely to see monetary policy normalizing?
I could step in. I mean, the official answer is when inflation starts ticking down, is under control. But if you recall from the presentation, the expectation is that inflation is back into the threes towards the end of or through 2023, and that would also bring interest rates back down. I would assume, Kevin, regionally probably the same, or?
Yeah, along those lines. I think as I mentioned before, the Caribbean tends to be price takers. So until we start to see some normalization in the global markets, we'll continue to see elevated prices. But we are starting to see some moderation in terms of the price levels locally, and hopefully that continues. But a key thing to look at is just to probably listen to the central bank discussions and just their indications of where they feel. Whenever you start to see them pull back on monetary policies and it start to you start to see less aggressive increases in rates, you'll know that we're in a turn cycle. And locally in Jamaica, we're starting to see where the central bank is posturing towards that. In Barbados, they have a peg currency, so monetary policy effectiveness is not quite the same.
Man. And since there are no other questions, we're going to wrap things up. We really appreciate all the insight from Kevin and Scott, and we want to thank all of you for taking the time to join us this afternoon. Thanks also to Tracy Cohen and Hope Macmillan Cannon, and also Corey for all your support in hosting this session. And as always, if you have any questions or thoughts, or you want to discuss with us, we are here to help. So feel free to reach out to your relationship managers for touch base. And we want to wish all of you a wonderful evening. Take care, everyone, and continue to stay safe.